couple of last thoughts around, your trading plan and all that. In thinking about technical traders, technical people who trade, active traders, and using technical analysis, and maybe like traditional long-term investors, like buy and hold type investors. If you think about a technical trader, in their plan has, like we walk through these kind of 5 steps, but the plan has rules from entry to exit, right? When you're going to buy something, you've got rules that help you with that and indicators you're going to use. And when you exit or sell, you've got rules and things that are conditions that need to be met to do that as well. So you have a definite plan around entry and exit. And you'll use things like stop losses and targeting, profit levels and all that. And so you're coupling that loss reduction and avoidance with profit, right? So you're actively trying to manage through that and using that in a real technical way, in a real dispassionate, unemotional way, certainly. And you're looking at what the charts and what the indicators tell you, and then you're reacting accordingly. If we think about a lot of traditional, quote unquote, traditional investors, many might have no plan, but hopefully have a plan, or they may have a rule for entry, right? So they might, enter into something based on something. Maybe it's some type of fundamental, whether it's a price to earnings or a value type of ratio or profit to growth, earnings to growth, PEG ratios. There's different types of things you could use as a traditional investor for entry, but there's no specific plan for exit. There's really more of an indefinite period for exit when things start changing around maybe that particular security or in the wider world or wider market around there. So a technical trader is looking at enter and exit, and they have a plan that covers everything. A traditional investor is looking at entry, and then they might even let that ride further. Like a buy and hold investor might let that ride for a very long time, years or more, or maybe forever. And the thing with that is, if executed correctly, either one can be successful. Either one can be successful. And so you want to think about, and you can have a combination. You might have your core part of your portfolio where it's mutual funds and exchange traded funds, for example, that are core, and you buy them and you hold them and you let them go for long periods of time. And then you might have another part of your portfolio where you're using that technical trading to get a better return on top of that buy and hold by having those entry and exit points as a technical analysis trader. And that can take many forms depending on your time frame, from day trading to more active trading to swing trading to whatever it might be. So that's kind of the difference between those. And as far as some of those final thoughts. And lastly, as we saw earlier, your trading rules, which is all part of your trading plan, and overall think of this is really going to come around the indicators you use, coupling with the risk profile that you have, how much time you have available for trading, and putting this all together as far as understanding how you're going to execute and look at as far as what's enjoyable for you in terms of your overall trading plan and the plan you're going to follow. So again, keep that in the back of the mind, the indicators that you've learned that you want to use, understanding a little bit more about your own risk. Starting slowly is perfectly good. Certainly using things like paper trading, back testing to get you comfortable. Those are good ways to get going. And then as you keep developing, then you'll adapt from there as you become more experienced and more successful.